good afternoon, everyone, and welcome to today's event on fixed income volatility, inflation, interest rates, and ultimately how to continue delivering value for clients in what has been a difficult market environment, in particular for bonds thus far. My name is Gerald Gugger, Head of Content Strategy at Manning & Napier, and I'll be leading today's discussion. And I'm joined here today by two individual analysts within our fixed income research team. They each spend their days digging through the intricacies of the bond market, specific issuances, sectors, themes. I know you each have your areas of expertise. This is what you guys do all day, every day. And so first, I'm going to start with Marc Bushallow, Managing Director of Fixed Income and a member of our investment policy group. Marc has a lengthy background covering all things fixed income during both his time here, which dates back to 1999, as well as elsewhere. Yes, I believe 1999. Focusing on high yield credit, bond structures, syndications, covenants, and more. Marc, welcome.
Thanks a lot, Jerry. Happy to be here.
And I'm also joined here today by Brad Cronister, Senior Analyst within our fixed income team and a specialist in global macroeconomics. Brad has been with Manning and the fixed income group for over a decade, covering global fixed income markets, macro, and more, but with an emphasis on global interest rates and foreign exchange. Brad, happy to have you here today.
Thanks, Jerry.
For those who are joining us for the first time, and we know there are some of you, Manning & Napier is an investment manager headquartered in Rochester, New York, managing over $20 billion in portfolios ranging from fixed income specifically to equities as well as multi-asset class. We've been managing traditional, fundamentally driven bottom-up portfolios for over 5 decades, supported by disciplined processes, strategies, and risk management frameworks, of which you'll hear about a few during today's call. So with that, let's discuss our agenda, and it will be a bit more free-flowing than normal. We're first going to start by talking about the state of the bond market, and then we're going to dive into a lot of those specific issues that we mentioned to begin. So with that, the state of the bond market today has certainly been jostled to a large extent by inflation. So Brad, maybe let's start there.
Yeah, sure. So we thought we would start with a chart that has over 300 years of price data. We got this from the Federal Reserve. And as you can see, outside of war times and really the 1970s, we haven't really seen inflation at levels that we're experiencing right now. The chart is smooth over a 5-year process. So obviously we'll get into the last 18 months later in the presentation. But for the most part, we haven't dealt with 7-8% inflation in 40 years and outside of war times. But that's kind of been the crux of the bond market sell-off over the last 6 to 9 months, and really why we've seen so much carnage both in price and in market structure.
Yeah, no, I know we wanted to make sure everyone knew that we were going to talk a little bit about Back to the Future. I don't know if listeners knew we were going back to 1800, but here you go. This is the kind of analysis you're going to get. But no, let's zero in a little more closely, Brad, on what we've seen specifically over the past 10 or 15 years.
Yeah, so when we look at the sell-off in rates over the last, what we're going to call it 6 to 9 months, it's both been inflation expectations moving higher. Inflation expectations coming out of COVID were around 1%. That is significantly lower than what we've experienced. And then real yields have actually moved higher as well. So we've seen inflation expectations move from 1% to 3%, and then real yields move from significantly negative levels into we're seeing about 0.25% today. So that's been really the foundation for the sell-off in the fixed income markets.
Yeah, and for those who are a little bit unaware, just to explain the visual that we're looking at here, that is the US 10-year, and I believe it did break 3%, I think yesterday again, that being the two pieces of real yield and inflation together making up that nominal yield. And so Brad, to your point, it has been both on the real side and the inflation side that you're seeing drive the uptick over the past 4 or 5 months.
Yeah, it's been on both. The real yield being tied towards tighter monetary policy and inflation expectations, obviously, the 8% we've experienced.
Yeah, I mean, it's been a sharp move, and we know we have a lot of financial professionals on the call today, Marc, and many of them are having difficult conversations with clients about what that sharp move in interest rates has done to bond market performance. And we'd like to share a few of the most common indices right now.
Yeah, thanks, Jerry. I mean, this chart, I think, does a great job in illustrating that it's been very painful across the fixed income markets. There's not been any place to hide with interest rates higher across the curve and credit spreads also wider. So we've seen losses across the fixed income market. Look, it's very painful for clients when they open their statement and they see the mark-to-market losses on the fixed income parts of their portfolio and the fixed income accounts. The happy story to that is, when interest rates were 1%, nobody wanted to earn 1% returns. And in the long run, you couldn't meet your needs when every time you got a coupon payment or principal payment back, you were reinvesting at 1%. While the adjustment period has been painful, every coupon payment, every piece of principal you get back, you're now investing at 3-4%, depending on the market you are, and clients are able to meet their needs and generate real returns. I guess the converse is also true, is clients are typically very happy in the middle of a recession when they open their statement and they see that the big mark-to-market unrealized gains. But again, those set clients up for a much more difficult environment, which is that gaining 0 to 1%. So while this adjustment has been painful, this is actually good for clients in the long run to be able to meet their needs.
Are you suggesting that clients were not particularly happy clipping off 1% on the U.S. 10-year Treasury yield?
I do suspect that is exactly true, Jerry.
But it has been a difficult adjustment period thus far. Yeah,
a very difficult and painful adjustment.
Yeah, no doubt. And that point being about the distinction between what we're going through today, but what that then means going forward is something that I know we're going to get to a little bit later in the presentation. But first, now that we've discussed the state of the bond market, shown what everyone, I assume, is aware of what has been a difficult start to the year, let's dive into specifically what's driving a lot of that. And we do want to go back and continue to more thoroughly unpack inflation, because that is the big difference between what we're seeing now and what we've seen in years past.
Yeah, and I think it's important to break down, why inflation is so high. For 25, 30 years, we saw core goods prices being mostly oscillating around 0%. So it was deflationary to disinflationary as globalization came through the world. We had easier and better supply chain management and more competition in general. Post-COVID, we've seen a huge spike in goods. Now, part of that is supply chains being gunked up, but also we saw a huge surge in demand. And we've seen goods prices now be above double digits for multiple months. And that's really what's been driving this pricing higher in inflation. Now, we tend to think that goods pricing is going to come down from these levels, so we don't expect to experience good pricing to be above 5% on a year-over-year basis sustainably. But that being said, the services prices are beginning to percolate. Services are very much tied towards wages, given now wages are a big input for service prices. And so when you look at services pricing, they're starting to move higher, closer to 5%, and they're really a large part of core inflation. So while goods pricing is going to come down fairly aggressively over the next 6 to 9 months, we do expect that inflation in general is going to stay relatively high.
The first time I had seen this, and you guys had brought this to my attention, I was startled by the length of time, really. I mean, this is 2 full decades of goods pricing. We talk about where has inflation been, why has inflation been kind of just, I don't know, some people have said dead, maybe dead's a little harsh, but that's been a huge drag for a long time now.
Yeah, and again, it's both a supply and demand problem. On the demand side, for the first time since data that we've looked back, we saw an acceleration in personal consumption given fiscal transfers to consumer. So you had the consumer flush with cash. On top of that, they couldn't go anywhere to spend it, so they spent it on goods. So not only did we have supply chain bottlenecks, but we also saw a huge surge in demand on the goods side. So, again, we think that is going to roll over, and we're likely seeing the peak of inflation. But the sustainable trend for inflation might be higher than what we experienced over the last 25 years.
Yeah, and I want to put a pin in that supply chain comment and get back to it in a minute. Another item you mentioned a minute ago was that relationship between, so right, we're breaking down goods versus services here, but that relationship of the services component of inflation to the labor market and to wage growth specifically.
Yeah, if you look at this chart, what we've done is aggregated a number of different employment indicators, not just the headline U3 unemployment rate. And not surprisingly, we're seeing extremely tight labor markets, which have led to much higher wage growth. And that's kind of what will continue and what has led to the higher services prices moving forward.
Yeah, that wage growth component is an absolute key today. There's no doubt about it. And to be clear, that employment CAIZ score is in fact a proprietary indicator that you guys have created, yes, in the amalgamation of a number of other ones, but to help distill out exactly what we're seeing within the labor market. These are just different types of tools and analyses that we can do to try to get more clarity on what we're ultimately seeing. So let's now talk about supply chains. You had said you anticipate the goods inflation perhaps rolling over, and I suspect this is a big reason why.
Yeah, we track these supply chain pressures. This is data from the New York Fed that has aggregated a number of different supply chain indicators. Mark's done a lot of work on looking at other supply chain pressures that he's been focusing on the high yield market, for example. So we're seeing that pressure roll off a little bit.
Yeah, I mean, I think obviously, it started to roll over. Supply chain pressures are starting to improve as we came into 2022. And then you had zero COVID with the outbreak in China, as well as the war in the Ukraine. I guess the good news is we haven't seen a spike in those supply chain pressures. They haven't begun to become even more elevated. So we do suspect that they will work themselves out. I think if you just think about it in the sense of what we're seeing in everyday life, look, port congestion's down. We're not seeing on TV a whole bunch of ships parked out in the bay anymore. Retail inventories are actually up and in some places too high, which obviously is not something that was commonplace a year ago. And then things like shipping rates have fallen materially over the past few months, trucking demand. So things are beginning to normalize, but are still not yet back to where they started.
Mark, I want to ask you a follow-up question, and this might be a little more philosophical per se, but the story of supply chains, and we saw it a little bit 2 charts ago, goods deflation for a number of years, the world becoming more global. Can you talk a little bit about how you guys are thinking about globalization and maybe that theme I see out there a lot about de-globalization?
Yeah, thanks, Jared. And I think it's a really good point because, I mean, on the first chart, everybody's talking about the past, the spike to inflation that we've seen over the past 6 to 9 months. But, one of the bigger important points on that first chart was inflation and interest rates have been coming down for 40 years. A lot of that was driven by big secular forces, demographics, debt, globalization being the key ones. I mean, within that, you had China bringing in millions and millions of workers to the global labor force. The Berlin Wall fell. Eastern Europe brought millions and millions of workers to the global labor force. All those workers have been absorbed, so that's no longer a tailwind to the sort of that disinflationary thing. We do think that there are many points that are beginning to inflect, such as globalization with geopolitical rivalries. It's gone from the cheapest source of labor to friendly support sources of supply. So we do think that several of those key factors are beginning to inflect that may lead to a different world than we were in tune for the past 40 years.
And perhaps put a little more pressure on that goods deflation that we've seen, and that may not be a repeat of what we've seen in the past.
Right, exactly. I mean, just in time and very cheapest sourcing is giving way to the availability as well as to ensure that you have supply for customers going forward.
So then let me ask, you talk about secular forces, you talk about these big changes, right? And how the world may be different than what it's been in the past. We're here to talk about the bond market, and we have been going through 40 to 45 years of a pretty palatable bond market, I would think. I mean, the 40-year bond bull market. Do we feel like some of these forces are changing enough that we might be on the cusp of the end of that?
Yeah, again, we do think that there's meaningful changes in a lot of those secular forces that drove it. And that is not to say that, look, the sharp increase in interest rates over the past 6 to 9 months has been so jarring for the markets and for clients. That's not as much a reflection about the secular forces. That's a lot of the cyclical and some of the issues related to COVID that we talked about with the supply chains and demand. But we do think that that sets the page for the next 10, 20 years. Probably being the end of that, sort of lower lows and lower highs. It could be a very different market environment than many people have been accustomed to, or probably at this point, most people that are involved in the financial markets.
Yeah, just to harp on that, it wasn't a straight line for 40 years, right? We saw lower lows, lower highs. The turning isn't going to be a V shape, but we suspect that structurally we're likely to see higher highs and higher lows. So there might be opportunity during those different environments, but for the most part, the 75, 80 basis point that we saw in the 10-year, that could be a structural low on the 10-year.
Yeah, almost as if we're really facing a bit of a regime change going forward. I would like to think that that means that approaches that financial professionals, many of whom are on this call today, have deployed for a number of years, maybe needs to evolve a little bit going forward. I know that might be something you want to talk about later. We can hold on to that a little bit if you'd like, but.
Yeah, I mean, I think that's probably a great topic to take it as we get to the slides, but I do think there are some strategies and approaches. I think one of the things that I would think about it is, using the aggregate has obviously been the gold standard of how people use fixed income, especially in balanced portfolios. One of the interesting things to point out is the aggregate is more risky than it's ever been. The duration on the aggregate has expanded from 4.5 to 6.5. So just at the point that we're potentially hitting this big inflection point for a multi-year or decade period, you have more risk than ever to interest rates in the aggregate. The amount of credit risk in the Barclays aggregate is greater than it's ever been because, again, you have more corporates issuing longer bonds and having lower quality than ever before. So I think, being able to build a portfolio that recognizes the changes that are coming as opposed to just, using the aggregate may be a much more attractive approach going forward.
Not sure why I'm smiling as you talk about more risks than we've seen in a long time, a very difficult start to the year, but there are options. It's not like there are no options. So we'll get back to that in a minute. And I guess to put a more positive spin on things, let's get more positive for a minute. We do have a consumer that is still doing reasonably well.
Yeah, I think for the most part, where the consumer stands right now, the consumer's in a good spot, right? We have a decent amount of savings within the economy. Job growth is still pretty good, and wages are high. There are some headwinds, though, that the consumer is going to be facing. One, higher interest rates, so that includes mortgages. Any funding costs are going to be higher. Obviously, inflation is biting into the consumer. But for the most part, where the consumer stands right now, it's in a good, fairly healthy spot compared to where we saw it, in 2007, 2008. There's been a lot of deleveraging. So while, headwinds are in front of us, likely not the source of trouble.
And can you give a little bit of a breakdown of exactly what we're visualizing here?
Yeah, so this looks at consumption over the last 20 years. And as you can see, the slope for services is much steeper than the slope for goods. After the global financial crisis, we saw a preference for services. However, post-COVID or during COVID, we saw a huge spike in goods, which typically when you go through a recession, people pull back on those good purchases. And what we saw is the demand for goods went significantly above the previous trend. And again, that highlights why goods pricing was so high, why supply chains had such a difficult time reacting to the higher demand. So, we expect this to come back closer to trend. The darker line for consumption of goods and services will continue to move closer to its previous slope.
And really, this is a visual of the shock to the system that we went through, right? And also a bit of a visual of what we, policymakers, fiscal spending did to try to account for that.
Yeah, again, first time the consumer saw income growth during a recession.
It's remarkable. So then let me ask you, because I know people are worried about this and they see what we've done over the past 2 years, which is quite literally inject money into checking accounts and in some cases through the mail, I suppose. But are there going to be any long-term consequences of this?
We'll see. I do think the reaction might be different from COVID if inflation remains high. I think inflation is a constraint for fiscal policymakers to start handing out money. We see in consumer surveys that we track that inflation is becoming one of the main issues for the consumer. And especially when you're going to have midterm elections in about 5 months, that is an issue that policymakers are trying to address. Maybe not as quick as we would like.
Yeah, I mean, I think it's interesting to note that typically in an election year, people would like policy as easy as possible heading into the elections. And yet Chair Powell was called to the White House and there's bipartisan support for for him to squash inflation. So it's become a bipartisan top of the agenda item for both parties. Obviously, that's relatively uncommon, especially in an election where they like to be handing out money and happiness to all the voters.
I'm glad that we've gotten to the point of the proceedings where we are handing out happiness as well. But all right, so let's talk about Jay Powell for a minute. We talked a little bit about fiscal spending, and it was clearly, albeit a blunt instrument, it was a powerful instrument. Historically, we tend to rely, and I guess more recent history, I suppose, on monetary policies being that tool a little bit. So, Brad, Mark, whichever one of you wants to speak to it first, can you talk a little bit, I guess, one, what we're showing here, because I don't know if all of our listeners are aware of what the shadow Fed funds rate is and then why it's important.
Sure, Jerry. So the shadow Fed funds rate tries to quantify what rate cuts would look like if it incorporated quantitative easing. So if you look at the reaction post 08, we saw QE1, QE2, QE3, QT, QE infinity. Effectively, what that did was cut rates to what would effectively be about -3%, without having to do what Japan and the ECB have done and gone into negative territory for rates. But what it tries to do is tries to quantify what quantitative easing does to rates. As you can see, as purchases end, you get back closer to the zero lower bound, and then rate hikes commence. Post-COVID, we saw a very quick reaction by policymakers. The Federal Reserve started increasing their balance sheet by $120 billion per month. And effectively, they went from slightly above 2% policy rate in the middle part of 2019. And then when you include quantitative easing, effectively, they cut rates down to -2%. So what that tries to do is try to really quantify, illustrate the impact that quantitative easing can have on policy on a like-for-like basis with rates. And then as we've seen, we ended QE, this interim of QE in the fourth quarter of 2021 and have commenced 75 basis points of hike so far.
Is there, and just as a point of clarity, much of a distinction between quantitative tightening and the reducing of the balance sheet?
No, quantitative tightening, the ending purchases is in effect getting closer to zero. Monetary policy works on a rate of change according to this model. So just ending purchase is what gets you back to zero.
So I think most of your comments, and correct me if I'm wrong, were very US centric. Can you talk a little bit about what you're seeing abroad?
Yeah, and I think what's different than the hiking cycle from 2015 to 2018 is the rest of the world is now on the same page as the Federal Reserve. We were watching the ECB this morning, and they're getting ready to hike rates for the first time since 2011. Next month by 25 basis points. They've kind of given us a look into potentially doing 50 basis points in September, which is a huge change. If you remember, they're at -50 basis points on the deposit rate right now, which they've been in for the last at least 5 years, as well as doing quantitative easing. So that's very different. We've seen the Bank of England raise their rate, policy rate to 1%. Bank of Canada, Reserve Bank of Australia have all increased rates by over 50 basis points in their one meeting. So we are seeing a global monetary tightening. Emerging markets started doing that last year. They've kind of been ahead of the curve for the first time. But for the most part, we are seeing outside of Japan and China, we're seeing tightening of monetary policy like we haven't seen in quite a while.
Yeah, and I believe you shared a statistic yesterday on just the nature of the economic situation amid what they're trying to tighten into.
Yeah, it's pretty. The ECB is in a difficult spot. with the war going on. But it seems to us that they might be tightening into a recession. When you look at retail sales in Germany, they declined by 5.5% month on month in May. Industrial production, very much tied to Chinese exports. When you look at PMI data out of China, it's pretty bad given the lockdown. So Europe, the place where Europe is from an economic standpoint, while the ECB is trying to tighten, is extremely difficult for them to navigate.
So with that said, in understanding where the trajectory of monetary policy is headed, really what I think you would say, and tell me if I'm wrong, is financial conditions is what we're trying to monitor right now.
And that's what the Fed is targeting with tightening monetary policy. They can't do anything to help supply chains, right? Their instruments work by tightening financial conditions. And there are a number of different channels that financial conditions tighten through. The dollar is one. A stronger dollar typically tightens financial conditions. Wider credit spreads, higher real rates. These have all, lower equity markets. These have all led to tightening of financial conditions over the last 6 months. And honestly, that's kind of what the Fed is trying to target. Former New York Fed President Bill Dudley came out with a opinion piece a few months ago and actually said lower equities are what the Fed is trying to accomplish through their program. They're trying to lower demand, which would then in part lower inflation.
You know, if you put a number on what he said there?
He didn't, yeah, he didn't.
Just lower broadly.
Lower broadly, yeah.
Okay, fair enough. Well, some success, I suppose, thus far. So with that in mind, knowing that they're trying to tighten financial conditions, thinking about how quickly they've accelerated the pace of what they're trying to accomplish, it does seem as if to a large extent they are behind the curve.
Yeah, I would agree, Jerry. And I think this is actually a fantastic table. It may seem odd to say this because we're just 2 years into the cycle, but it's actually, in our opinion, it's relatively later cycle with unemployment already at full employment. Another way to think about this is not that we're 2 years into the cycle, but we may be 13 years into the cycle where in 2020 you turned off the economy, turned back the economy back on. You didn't really flush out any of the excesses, which is really the point of a recession in a capitalist economy, is to get rid of those excesses. And typically the Fed wants to lean into inflation so that they can go slow without having to kill the economy. And in this case, as it seems to go in life, they changed their policy just as the facts in the world were changing, and also you had the exogenous impact of things like COVID and the supply chains, which they hadn't seen in previous cycles, where they were moving to a more permissive to let inflation run a little bit longer before they leaned into the wind. And they got behind very quickly this time, which is why you're now having to see 50, 50, 50 for them to try to catch back up, to try to put the inflation in the bottle. Brad commented that Europe is probably tightening into a recession. Coming into 2022, we already thought that the US was set to slow. Again, Brad had talked about the 2021 global rate hiking cycle. You had commodities up materially in 2021. Obviously, that's continued in 2022. Those are things that have lagged impacts on the economy. So 2021's lagged impacts or 2022's slowdown already. So while the Fed may not be hiking into a recession like they are in Europe, the Fed is certainly going to be hiking, and at this point, very aggressively into what was likely to be a slowing growth environment anyways in the US.
I got to tell you, I'm still a little caught up in the table specifically. I agree. It does seem to jump out at you. It's been a long time since we've seen so much really blue across the board on one particular line. I mean, really back to the 70s or 80s.
Yeah, again, they had tried to, because they want to moderate the swings in the economy and not exasperate them. They're typically trying to lean into the wind. And in this case, they're really having to go full throttle when you're already there.
And I suspect those types of sudden moves are perhaps suboptimal. And so it makes me wonder, and I'll just throw this out there. I don't know if you guys are prepared to give us a letter, but if you were to grade Chairman Powell on how he has handled this so far, what kind of grade would you give?
I think it has to be incomplete, right? They have not completed the task yet. I think it is important, though, to go back to March of 2020 and the kind of abyss that markets were looking into. The liquidity environment that we were dealing with in the most liquid of assets, U.S. Treasuries had huge bid-ask spreads if it wasn't, a 2-year on-the-run Treasury. TIPS were extremely difficult to trade. They had to step in and do something, and they did with serious firepower. So I think the initial reaction was actually what was needed given the circumstances. Fast forward, a year, 18 months later, so we're looking at second quarter of 2021, they were extremely, extremely slow to want to get off of $120 billion a month of asset purchases. It was fairly clear that the economy was improving, employment was roaring, inflation was starting to turn and getting close and at some point above their 2% target. There was no need to continue to throw as much stimulus on the monetary side as they were in April of 2020. So I think they were slow to react, and now they're kind of reaping what they sow. They're going from having the foot all the way on the accelerator to now having the brake all the way, the accelerator all the way to the floor, and then just stomping on the brake. And for functioning of markets, for functioning of the economy, that's suboptimal. So they are trying to really walk a tightrope in terms of getting this soft landing that they talk about. I think it's going to be extremely difficult. History suggests that they are unlikely to be able to, create increased supply in labor without causing a recession. So, it's incomplete for now, but I think it's going to be very difficult for them to get a passing grade.
I would agree with what Brad said. Look, hindsight is 2020, but the Fed had emergency or crisis policies in place well after it was clear that the economy had healed and employment was improving rapidly. So yeah, that has been the big issue, and that's why you see what you see on the chart right here.
And Brad, you said a minute ago, watching that employment figure, as far as once that starts rising, it can be particularly difficult for them to rein that in.
Yeah, so there's a thing called the Somme rule, which looks at the average, the moving average of unemployment. And if you get unemployment, the month-on-month or the monthly unemployment level to go above that 9-month moving average, that typically means that we're in recession. So it is very, very difficult to get, slight uptick in unemployment to try to ease price pressure without sending the economy into recession. So yeah, it's something that we continue to monitor.
I think that just speaks to the fact that the economy is not the kind of thing that you're not driving a race car here, you're steering a battleship, right?
Yep.
And so keeping that in mind. So I guess with all of that said, then knowing that there are a couple of these key things that we're watching, but thinking more, all right, going forward, we've laid out the concerns around inflation and being behind the curve and tools in the toolbox that they have to potentially fight perhaps a drawdown that may or may not still be there anymore. Where do you see, and I know we got the visual here we want to put up in this particular being 2s and 10s, because the yield curve is certainly closely watched as an indicator for that going forward question. So I guess, Marc, I'll look to you. What do you see as paths forward here?
Yeah, thanks, Jerry. So I would say, first of all, we likely saw the peaking of inflation with the March release, which was released in April. That's important in so much as that it may be approaching a point of us seeing peak Fed hawkishness. That doesn't mean that the Fed's going to start cutting rates. That doesn't mean that the Fed's going to remove rate hikes from the forecast. It means that the market doesn't every day, week, month, quarter have to keep putting more and more hike forecasts into their forecast, which is what made the very difficult market environment over the past 6 to 9 months. It was that people were constantly having to upgrade the level of hikes they think the Fed was going to have to make because inflation kept coming in higher than expected. So to the extent we've seen, again, peak inflation, which could translate to peak Fed hawkishness, which is then just the Fed delivering what the market is pricing in, it may be a less difficult market environment going forward. The yield curve has been one of the greatest economic forecasters out there, sort of all the variables, and everybody that tries it. When you look at it now, we would say that the curve is very flat. When you get up to 5 years, yeah, there's a weird kink at the 20. But generally, the curve is very flat, and it has steepened a little bit In the past few weeks, it had gotten even flatter. Typically, the time that you have to be really concerned is when the Fed then is successful in aggressively pushing up the front end, but that the back end doesn't go up with it or starts to come down a little bit. And that's the market saying that future growth and inflation is going to be lower than current. We haven't seen that more severe inversion. It would lead you to think sort of that the recession is a completely done deal. So this would argue, the market is still arguing there is some chance the Fed's going to pull off the Houdini act of the soft landing, but certainly the curve is flattened as you would expect when the Fed aggressively increases interest rates.
I just want to unpack one little bit there to make sure I understand.
The Houdini comment?
Specifically, if you know how Houdini did it, I think there are a lot of people who would like to know. No, that point about growth on the long end, which is more driven by the economy and markets versus what the Fed has more aggressive control over on the shorter end.
Yeah, and I think that's a great point. That is really the value in what you're looking at when you look at the yield curve. The front end is, based on the market pricing and how many times the Fed going to rate hikes. So this is looking at the 10s versus the 2. The 2-year is largely a reflection of the market putting together the expected Fed fund rate forecast over the next 2 years. Obviously, when you get out to 10 or 30 years, that is just more reflective of people's growth and inflation expectations and how they price that part of the curve. So as you get, the Fed going to hike and hike more, the front end of the curve is coming up. At the point that the back end of the curve starts coming down or is no longer going up, that's the market telling you that they think that the pricing of the Fed has gone too far.
So one other point then along those lines, you mentioned soft landing earlier, and I do want to go back to that. So I think there's a lot of discussion right now about whether the Fed, and I know we think it's difficult for them to stop on a dime, but there are some out there who do think that a soft landing is plausible. What would that scenario look like?
Look, it is plausible. Again, it's a very difficult tightrope. I think, and you saw some encouraging news with this in the most recent employment report. If they're able to draw more people into the labor market, which would then soften some of those wage pressures that you're seeing, they may be able to, as inflation is also coming down, then the Fed would not need to keep having to raise more and more aggressively. Again, there was a lot of if, ands, or buts there, which is again why we think it's a difficult scenario, but certainly, continued improvement in the labor force by drawing more people into the labor force with inflation coming down sort of on plan or hope at this point would provide the situation where that is sort of a plausible outcome.
And that would be more of like the positive outcome here would be a soft landing, which I would still think then would leave us in a, I think about the table we just spent a lot of time looking at, a later cycle environment.
Yeah, that's a great comment. I mean, we are in the later cycle, and if you are successful in achieving the soft landing, we're still already at full employment. Because as Brad mentioned earlier, if you get a meaningful turn up in unemployment, that usually doesn't then recede quickly. That's usually the beginning of a trend in the negative direction.
So if that's the positive scenario and there is the more bearish scenario as well, maybe this is just the $1 million question, but okay, what to do? What should financial professionals be doing with the bond portions of client portfolios, given a challenging outlook and also what's been a challenging start to the year?
A very challenging start to the year, to say the least. Yeah, that is the $1 million question. And then, we think mandates and opportunities that can be more opportunistic and look for parts of the bond market that have value that aren't necessarily tethered just to movements in interest rates. So again, something like the aggregate, there's credit in that and there's returns, but the returns on that in a day to week, month to month are largely driven by movement in interest rates. There's short duration, unconstrained, other types of strategies that may be able to be more nimble and are able to earn returns that are not tied directly to just movements in interest rates more broadly.
Yeah, and it makes me think about what Brad had said a little while ago about higher highs and lower lows and a changing regime. Being active and using a wider set of tools in the toolbox could make a lot of sense going forward. All right, well, I guess with that then, I did want to leave a good chunk of this discussion open for Q&A. I can't recall if I even mentioned that at the beginning, but we do want to have the team open for questions. So feel free to punch them into the Q&A box and we will get to as many as we can. I know some may be specific, but as broadly applicable as they can be, we'd love to address them all for you. Also, before I do turn it over to Q&A, I would like to mention that we do have a variety of insights on our website. I know, Mark, you took the time to write a letter to describe a bunch of this about a month ago. So we encourage you all to take a look at that for a little bit more color and a little bit more detail on these paths forward and what financial professionals could do about it. In addition, we do have other insights on there as well, just on inflation, on interest rates, on the equity market, if you do dabble there, but we'll leave the equity market out of today's conversation specifically. So at any rate, we encourage you all to please take a look and subscribe. And with that, let us know if you have any questions in the meantime. A number of you also did send in questions ahead of time, so we did grab a couple as well, and we encourage you all to pre-submit questions. It helps us make these discussions as relevant for all of you as they can be. And so one of which that did catch our eye, and I suppose in part prompted by a lot of things that we were discussing today, which is thinking about history as a clue to what the world might look like going forward. So I'd like to read this question. What are the key similarities and differences between the current inflationary environment and the period of the late 70s, early 80s?
Yeah, well, I think the easy one is inflation is high. But what's vastly different is the starting point of interest rates. When inflation was double digits in the 70s and early 80s, interest rates were double digits. So it's a very, very different environment from that standpoint. In terms of the sustainability of inflation, the demographic situation that we see now, while improving in the US, is still very different than the 70s and 80s. Working age population were accelerating in the 70s. Increase in labor force participation was also increasing. And then credit creation was also taking off. Those are not there currently. The demographic situation is very different. We have significantly slower working age population growth. So while there are some similarities, specifically high inflation, the durability of that is much less.
Yeah, I mean, I think the other interesting thing to point out about the 70s, which is often comes up in the discussion with high inflation, is that the 70s was the Phillips curve experiment, where there was this trade-off between unemployment and inflation. And the only thing they didn't realize is they had to keep trading more and more inflation to have that trade-off work. And that led to an extended period of really rapid growth in the monetary base, so in things like M2. In the current period, we haven't had a decade of excessive monetary growth build up. It's been more a short burst, more akin to what you have seen in wartime periods, where there's a short burst of liquidity build up. So they had really a decade of excesses building up that led to the 70s. This has been more, again, it was an on-off and a surge in liquidity and stimulus that was provided.
So not necessarily that the Phillips curve had died recently and is being resuscitated, but that it just was kind of more, we just weren't there yet. The conditions didn't allow for it to really be impactful.
And also, I would say too, inflation expectations got extremely ingrained in the 70s. People became accustomed to high levels of inflation, which is one of the reasons the policymakers are trying to squash inflation right now. They don't want inflation and high inflation expectations to become embedded within consumer expectations.
That it's kind of a self-fulfilling.
Exactly.
Yep.
The wage spiral.
Yep. And another point too that you had made a minute ago, it's funny you bring up demographics here. I know you brought up demographics before. Something that doesn't exactly show up in the news every day, but does make a bigger long-term impact, and being able to think longer term, have that type of perspective can make a difference.
Yeah, one of my favorite charts is looking at working age population and productivity growth. And if you chart those over time on a smooth basis, they pretty much follow each other. So demographics have a huge impact on the structural growth rate for economies.
I think I might have to have you show me that particular one too. I know we've put one proprietary number up there, and we'll have to look at another. All right, I do want to get to another question here. This listener asks, would be interested to know about other alternatives to traditional core bond fund investing.
Yeah, I think that's a great question, and that feeds back into some of the comments we made earlier. And I think it's also timely, based on we talked earlier that core aggregate type strategies actually have more risk than they've ever had at any point in the past. Again, higher durations, higher levels of credit risks. And we think there are alternatives, short durations, unconstrained type products that can generate returns that aren't necessarily tethered just to interest rates, and also, have significant ability for a manager to add value through changes over time. So we do think that those types of products, they've become popular more recently because of the move up in interest rates, but we do think those products are going to have real durability in the years and decades ahead, because they provide you that not only higher levels of return over a cycle, but also sort of uncorrelated to your traditional fixed income.
All right, Brad, I think this next one's for you, and I think it's a loaded question. So here we go. The U.S. government debt load. What are our latest thoughts about that? And do we think it's going to have an impact on interest rates?
So I think supply for the treasury market is interesting. It is one variable in a multivariable equation that leads to where 10-year treasuries or 30-year treasury rates end up. In and by itself, higher supply should lead to higher yields. That being said, in practice, when you look at debt levels, as they increase in the developed world, they typically lower yields as higher debt levels lowers potential growth moving forward. And so when you look at the structural move for nominal rates for most developed world, they just track nominal growth, and higher debt levels typically lead to lower growth. I think the famous example is Japan has the highest debt level per relative to GDP in the developed world, yet they have the lowest interest rates in the world. So high levels of debt, high levels of supply don't necessarily mean higher yields. Now, in emerging markets, that's typically true, or in the EU, where there's a credit component to some of those countries, that's more true. But for U.S. Treasuries, typically supply is a smaller factor in determining where yields end up.
And that Japan example you bring up, is that the situation that they call the widowmaker?
Yeah, people have been trying to short Japanese government bonds for the past 25 years, and I don't think anyone has been successful.
All right, I'm gonna grab another question here. This one is about the Fed increasing interest rates fast enough to control inflation. Brad, I know you had mentioned before that there's a self-fulfilling aspect to this. Do we feel like the cat's out of the bag here, or does it not quite work like that?
No, I mean, I think, when we think about the economy, first of all, the Fed will be increasing interest rates very quickly, and you're already starting to see that in higher long rates, higher mortgage rates. And when you think about economic growth, housing is already starting to weaken. And you may say housing's not 70% of the economy like consumption is, so that can't be that important. But housing has actually been the canary that has, been the best indicator on the side of economic indicators. And that's not because of the percent of the economy is, but because it provides you so much insight into the other parts of the economy. So housing has already begun to materially slow pretty much across the boards. So we do think that you're already starting to see the impacts, even though it's early days. And certainly as the Fed raises more and more, look, they may control, ultimately they will control inflation. The question is just, do you have to cause a recession to control it or not?
Brad, here's one, and Mark, please feel free to jump in on this one too, but we get this from time to time, so I want to throw it out there. Can you talk a little bit about the gold standard and perhaps how it relates? I don't know, Mark, Brad, whichever one of you kind of wants to take it first, but does the gold standard make sense to keep a check on monetary policy and inflation?
I don't think it's viable. I mean, once you've kind of gone away from that, I don't know that there is a going back. But I do think people's yearning for that is, some of the things that you've seen grow out, like Bitcoin and the popularity of those and the boom and bust you've seen there, I think has been people that have been searching for alternatives to currencies, because obviously we've now been in existence in a world for the past decades, but certainly it's increased over the past 15 years where QE's become commonplace, that people have become more and more concerned about debasing currencies. All
right, here's another one that we've got in from a listener asking about credit spreads, and in this case, increased risk in the high yield market. I think you had talked about that a little bit earlier, Mark. Anything additional you'd like to add?
Yeah, so I mean, interestingly, that the composition of the high yield market is amongst the highest quality that it's ever been. It has more double Bs than it's had at any time in its history, and that's a direct result of in 2020, a lot of investment grade companies got downgraded into high yield, and they were so now amongst the higher quality constituents. But obviously, when you think about risk, credit spreads within the high yield market are still relatively low. Given the moves we've seen in equities, the volatility we've seen in interest rates, and quite frankly, investment grade has proportionally widened significantly more than high yield. So we do think that where current credit spreads are, that the risk reward there is not what you would like it to be.
Could you also, while we're on various fixed income sectors, a listener here is asking about the MBS space. Anything worth adding there?
Yeah, I think at the margin, agency mortgage-backed securities have gotten modestly more attractive. One of the components within mortgage-backed securities is when you buy a mortgage-backed security, you're selling volatility. Volatility within the fixed income space, implied volatility, like when you look at things like the MOVE index, have increased significantly. And that's usually a good time to start selling volatility. I will say spreads for mortgages in general still remain, relatively unattractive. So, well, it might be time to start looking. It's certainly not a time to be all in on mortgages.
I would agree with that. And I think one of the interesting thing about mortgages, and we'll go a little bit of fixed income geek speak here, is that the negative convexity in mortgages is about as attractive as it's ever been. In plain English, what that means is obviously those bonds are prepayable at any time. If you move your house, if you refinance your mortgage, whatever that may be, those show up as prepayments in the underlying securities. But given the significant move in interest rates, most of those securities trade in the low 90s on a dollar price. So obviously prepayments are not a negative factor. And also prepayment expectations have obviously come way down because there's about zero incentive for anybody to refinance their mortgage at this point. So that, that negative convexity means typically if interest rates go up, the duration of your securities go up at the same time, just kind of a double whammy, but that's really been removed. So while spreads are not great there, to say the least, that has been about as attractive as it's ever been at any time in history. And for high quality securities, they become more interesting to us, which when the Fed was buying them all and valuations were terrible, they weren't very interesting at all.
I think the last time we did a webinar for financial professionals, you brought up negative convexity as well.
Fantastic.
But this time, Brad throws in the SOM curve, I believe it was. SOM curve. All right, this one I do want to, and I want to be courteous of time, although I do think our listeners appreciate the fixed income geek speak. This particular one, a couple of you asked, and this is kind of a very common question, so I've been sitting on it for a little bit, and I'll throw this one out there. But why, given the interest rate environment today, should financial professionals continue to utilize fixed income in portfolios, or in short, as one listener put it, why own bonds?
Thanks, Jerry. Great question. Obviously, we get those questions all the time from our clients, and they're brought on by what's been an exceptionally difficult 6 to 9 months in the fixed income market specifically, as well as the broader markets. I guess a couple of things I would throw it out is fixed income continues to play a very important role in meeting client needs. Two, given the move that's happened in fixed income, you're actually better positioned now to meet some of those objectives than you have been in some time. And while it may seem like, why would I ever own fixed income? Think back to post 08-09. Again, you had a period where interest rates were zero, and they were doing quantitative easing. But if you think about over that whole decade, with a very long cycle, you were still able to generate reasonable returns to meet client needs over time. So if you were going to give up on fixed income, the time to give up on it was last summer. The time to certainly give up on it is not now.
All right, well, with that, I do want to wrap up shortly before 5 o'clock. I would also make a reminder for many of you who have tuned in and would like to claim CFP CE credit. We're putting a link into the chat. I believe it's already there. And we'll also be sending out a link via email for a form you must fill out in order to do so. We appreciate all of you for being here for that. We also are sending out a link for a brief survey and we appreciate any feedback you can provide on both, what we discussed today, as well as Marc's performance specifically. I kid. But with that, if we didn't get to your question, and there are a number of them still sitting out there that I know we are tight on time, we will follow up with you afterwards. We appreciate all the engagement that we received from you this evening. And as a reminder, last but not least, a recording of this webinar will be emailed out shortly after today's event. So Marc, I appreciate having you here today.
Thanks, Evan.
And Brad, you too as well.
Yeah, you're welcome, Jerry.
And to all of our listeners, thank you for attending today's webinar.